stop. Before you buy a single stock, even a dollar stock, you need to watch this video. Because here's the uncomfortable truth. Most beginners think they understand how stock prices work, and they are completely wrong. They think someone in a boardroom with a fancy suit decides the price. They think it's controlled, calculated, and predictable. It's not. And that misunderstanding, that's exactly why most beginners lose money in their first year. Today, we're ripping back the curtain. You're going to see exactly how a stock price moves every single second, and more importantly, why it moves. Not just the surface level stuff, we're going deep. From the invisible war happening inside the order book, to the psychology that makes stocks fly to insane highs, even when the company barely makes a profit. By the end of this video, you will think about every stock price differently, whether you're looking at a $5 stock or a $500 one. So here's my question for you. Drop it in the comments right now. Do you think stock prices are mostly logic or mostly emotion? I'll reveal the answer later, and most of you will be surprised. Let's start with the most important thing nobody teaches beginners. The stock market is just an auction. A non-stop, chaotic, 24/7 global auction happening at blistering speed. On one side, you have buyers. On the other, sellers. And they are in a constant tug-of-war over price. But here's what most people don't see. Behind every stock, there's something called an order book. Think of it as the market's hidden battlefield. It's a live list that shows what buyers are willing to pay, these are called bids, shown in green, and what sellers are willing to accept. These are called asks, shown in red. The current price is simply the last point where a buyer and seller actually agreed to make a deal. Here's a critical detail most apps hide from you. That price you see on your screen right now, that's the last trade price, not necessarily the price you'd get if you tried to buy or sell this second. The real price you'd get is determined by the live bids and asks in the order book right now. That gap between the best bid and the best ask is called the spread, and it's essentially a hidden cost every trader pays. Remember that. Here's where it gets fascinating, and this is the part finance textbooks skip entirely. Stock prices don't just move because of math, they move because of human emotion, fear, greed, FOMO, panic. Let me paint two pictures. Picture one, good news hits. Earnings beat expectations, investors get excited. Buyers flood in, desperate not to miss out. They start bidding higher and higher just to get their hands on shares. Sellers notice this frenzy and they raise their asking price. This is greed at work, and the stock price shoots up. Picture two, bad news drops. Maybe a product recall, a CEO scandal, or market crash. Sellers panic. They want out immediately. They start dropping their asking price lower and lower just to find a buyer. This is fear at work, and the stock price tanks. Ask yourself this, when you see a stock dropping, is your first instinct to think great deal or danger? Most people feel danger, and that natural human reaction is exactly what the market exploits. The investors who make the most money, they've rewired this instinct. They've learned to be greedy when others are fearful, and fearful when others are greedy. Sound familiar? That's Warren Buffett's golden rule. Okay, so now we know how prices move, but the big question is, what should a stock actually be worth? This is where the concept of intrinsic value comes in, and understanding this is what separates serious investors from gamblers. Intrinsic value is the true, real-world value of a company, based not on hype or headlines, but on cold, hard fundamentals. Its earnings, its assets, its growth potential. Here's the simplest way to think about it. Imagine you're buying a pizza restaurant. You wouldn't just pay whatever the owner asks, right? You'd look at how much profit does it make every year? What equipment and property does it own? How fast is it growing? That's exactly what serious investors do with stocks. Now here's the critical warning. Intrinsic value is not a fixed number, it is an estimate. Two smart analysts can look at the same company and come up with completely different values. It's less like measuring a table, objective, and more like predicting next year's weather, an educated guess. This is why markets disagree. This is why stocks get mispriced. And this is where opportunities and disasters are born. So how do you actually calculate intrinsic value? There are 4 main methods. Let's break them down. Method 1. Discounted cash flow. This is the gold standard. You estimate how much cash the company will generate in the future. Then you discount it back to what that cash is worth today. Why? Because $100 next year isn't worth the same as $100 right now. Inflation erodes value over time. If a company generates $100 a year for 3 years at a 10% discount rate, those future earnings are worth about $91, $83, and $75 today. Add a terminal value estimate for long-term worth and sum it all up. Divide by number of shares, that's your intrinsic value per share. Method 2. Dividend discount model. If a company pays regular dividends, you can value it by projecting those future dividend payments and discounting them back. Great for stable companies like utility firms. Method 3. Asset-based valuation. Simple. Add up everything the company owns, buildings, cash, equipment, subtract everything it owes, debts. What's left is the value. Works well for banks and real estate companies. Method 4. P/E ratio, or earnings multiple. Take the company's profit per share and multiply by the average ratio of similar companies. Quick but rough. No single method is perfect. Smart investors use multiple methods and treat the result as a range, not a precise number. Here's the question that confuses even experienced investors. If intrinsic value is the real worth of a company, why do so many stocks trade way above it? 2 words: future expectations. Let's talk about Tesla. For years, if you looked purely at Tesla's earnings and calculated intrinsic value using traditional methods, the stock price looked insanely overvalued, like absurdly high. The math didn't make sense. But millions of investors weren't buying Tesla for what it was making today. They were betting on what Tesla would become tomorrow. Electric cars, solar energy, robotics, the future. This is the brutal reality of growth investing. The market is not a calculator. It is a voting machine powered by human belief. 3 forces drive stocks above their intrinsic value. 1. Market sentiment, pure excitement, FOMO, herd mentality. 2. Future growth bets, investors paying a premium for tomorrow's potential. 3. Low interest rates. When banks pay almost nothing, people pour money into stocks, inflating prices. Here's the dangerous part. The market can stay irrational, meaning overvalued, for years, longer than most people can stay patient. Prices being overvalued doesn't mean they crash tomorrow. This is where beginners get burned. They short an overvalued stock and lose money for 2 years before being proven right. Let me bring this all together. After understanding both the mechanics and the psychology, here are the 5 real forces that move any stock price. Bookmark this. Force 1. Earnings reports. Every quarter, companies report profits. Beat expectations, stock jumps. Miss expectations, stock drops. Even a cent miss can crash a stock by 10% in one day. Force 2. News and events. CEO resignation, product launch, regulatory approval, lawsuit, merger announcement, any of these can send a stock flying or crashing within minutes. Force 3. Industry trends. When electric vehicles became the future, the entire EV sector surged, even companies that hadn't sold a single car yet. Force 4. Macroeconomics. Interest rates, inflation, unemployment, GDP. These are the invisible hands that push the entire market up or down simultaneously. Force 5. Pure sentiment and speculation. Sometimes a stock moves for no logical reason. A tweet, a meme, a Reddit thread. Remember GameStop? This is real, and it catches even professional investors off guard. Understanding all 5 forces is why successful investing isn't about finding the perfect stock. It's about understanding which forces are currently in play and making smarter bets than the crowd. This is the edge serious investors build. Not luck, not guessing. Pattern recognition plus patience. Here's what I want you to walk away with today, and this is more important than any formula or ratio. The stock market is not a machine, it is a mirror. It reflects the collective emotions, beliefs, and biases of millions of human beings making decisions under uncertainty every single day. That's why it goes up when logic says it shouldn't. That's why it crashes when fundamentals look fine. Because at its core, it's human. And the investors who consistently win, they do two things. One, they understand the mechanics, order books, intrinsic value, valuation methods. Two, they understand the psychology, their own emotions and the market's emotions. Armed with both, you don't just watch stock prices change, you understand why they're changing. And that changes everything about how you invest. Before you invest a single rupee or dollar, ask yourself, do I understand why this stock is priced where it is? If you can't answer that, you're not investing, you're gambling. That's the difference this video was built to give you. If this opened your eyes, smash that like button. It genuinely helps this channel grow. Subscribe for more breakdowns like this every week. And drop in the comments, were stock prices more logic or emotion? Let me know if your answer changed. See you in the next one.